When Congress approved the Financial Regulatory Overhaul bill last year, it directed the Federal Reserve to write new rules to prevent another financial crisis. Fed Chairman Ben Bernanke says those rules, which address the too-big-to-fail issue of the nation's financial institutions, will be unveiled in the coming months.
The new legislation addresses this on a number of levels, including enhanced oversight, tougher capital liquidity requirements, and the resolution regime, which is also very important. Just getting rid of too big to fail would be a very, very important step.
On the issue of the nation's burgeoning debt, Bernanke warns of the dangers in limiting the ability to borrow.
I think using the debt limit as a bargaining chip is quite risky.
Republicans want cuts in federal spending in exchange for any increase in the government's borrowing authority. Bernanke also acknowledged that the proposed rules could have unintended consequences for some smaller banks. If regulators limit what big banks can charge merchants for processing debt card transactions, smaller banks could have trouble competing.
It's going to affect the revenues of the small issuers, and it could result in some smaller banks being less profitable or even failing.
The Fed will allow the public, banks, and other interested parties to comment on the proposed regulations before they're implemented in January 2012. Mark Hamrick, Associated Press.